Some possible additional sentences are: a rate hike war is a scenario where the Federal Reserve and other central banks raise interest rates aggressively to combat inflation, which could have negative consequences for the economy and the financial markets. In this video, we will discuss some strategies for investors and consumers to prepare for a potential rate hike war. One strategy for investors is to diversify their portfolio across different asset classes, sectors, and regions. Some assets tend to perform better than others when interest rates rise, such as value stocks, commodities, real estate investment trusts, REITs, and inflation-protected securities, TIPS. These assets can help hedge against inflation and provide income. On the other hand, some assets tend to suffer when interest rates rise, such as growth stocks, bonds, utilities, and gold. These assets can lose value as their future cash flows are discounted at higher rates and their opportunity cost increases. Another strategy for investors is to adjust their risk tolerance and time horizon. A rate hike war could increase market volatility and uncertainty, which could lead to more frequent and severe corrections and crashes. Investors should be prepared for these fluctuations and avoid panic selling or buying based on emotions. Instead, they should focus on their long-term goals and stick to their investment plan. Investors should also review their risk profile and rebalance their portfolio accordingly. They may want to reduce their exposure to risky assets and increase their allocation to safer assets, such as cash, money market funds, or short-term bonds. A third strategy for investors is to seek professional advice. A rate hike war could pose many challenges and opportunities for investors, depending on their specific situation and objectives. Investors may benefit from consulting a financial planner or advisor who can help them navigate the changing market conditions and provide personalized recommendations. A professional can also help investors monitor their portfolio performance, adjust their asset allocation, optimize their tax efficiency, and plan for their retirement. One strategy for consumers is to pay down their debt as soon as possible. A rate hike war could make borrowing more expensive and difficult, especially for variable rate loans such as credit cards, mortgages, student loans, and car loans. Consumers should try to reduce their debt burden and avoid taking on new debt that they cannot afford. They should also compare different lenders and loan options to find the best deal and lock in low interest rates before they rise further. Another strategy for consumers is to save more and spend less. A rate hike war could erode the purchasing power of consumers and lower their disposable income. Consumers should try to increase their savings rate and build an emergency fund that can cover at least 6 months of living expenses. They should also cut down on unnecessary spending and create a realistic budget that prioritizes their needs over their wants. They should also look for ways to increase their income, such as asking for a raise, finding a side hustle, or investing in their skills. A third strategy for consumers is to protect their credit score. A rate hike war could make credit more scarce and selective, which means that lenders may tighten their lending standards and require higher credit scores from borrowers. Consumers should try to maintain or improve their credit score by paying their bills on time, keeping their credit utilization low, checking their credit reports regularly, and disputing any errors or frauds. These are some of the strategies that investors and consumers can use to prepare for a potential rate hike war. By following these tips, they can reduce their financial stress, improve their financial security, and take advantage of the opportunities that may arise in a rising interest rate environment.